Something has shifted in the foundation of global markets. Not suddenly, not dramatically, but unmistakably. If you've been watching silver, you've likely noticed the tension building beneath the surface, prices moving with unusual volatility, supply chains tightening, industrial demand accelerating while above-ground inventories decline. Meanwhile, monetary authorities continue wrestling with inflation they once called transitory, now acknowledging a longer struggle ahead. This isn't about predicting the future. It's about understanding the present moment with clear eyes and recognizing patterns that have played out before in financial history. Today, we're going to examine why the conditions forming around silver in 2026 may create stresses worse than what we witnessed in 1980, when silver briefly touched $50 an ounce before collapsing. But more importantly, we're going to discuss what that means for you, whether you already hold this asset or you're considering it for the first time. This conversation isn't for speculators chasing quick gains. It's for thoughtful people who want to understand how monetary systems respond under pressure, how commodity markets behave when fundamentals diverge from pricing, and how disciplined investors position themselves during periods of transition. Let's begin with context, because context is everything. To understand where we are, we need to understand where we've been. In January 1980, silver reached its nominal peak of approximately $50 per ounce. The Hunt brothers had attempted to corner the market, accumulating massive physical positions while simultaneously holding futures contracts. The price spike was spectacular. The collapse was devastating. But here's what many people forget. The conditions that allowed silver to reach that price had nothing to do with market manipulation alone. The late 1970s were characterized by monetary chaos. Inflation had been accelerating throughout the decade. The dollar had been completely severed from gold in 1971. Confidence in paper currencies was eroding. Real interest rates were deeply negative, meaning savers were losing purchasing power even as nominal rates climbed. People were searching desperately for stores of value. Gold and silver became monetary refugees, not because of speculation, but because traditional monetary anchors had failed. The Federal Reserve under Paul Volcker eventually broke that cycle by raising interest rates to punishing levels, well above 15%. The economic pain was severe. Unemployment spiked, recessions followed, but inflation was eventually tamed and confidence in the dollar was restored. Silver crashed because the fundamental driver, monetary disorder, was addressed through aggressive policy intervention. Now ask yourself this: do we have that same option today? The world of 1980 had problems, but it also had solutions available. The United States national debt was approximately $1 trillion. Today, it exceeds $36 trillion and continues growing at an accelerating pace. Back then, raising interest rates to extreme levels was economically painful but fiscally possible. The government could afford the higher borrowing costs. Today, every percentage point increase in interest rates adds hundreds of billions of dollars to annual debt servicing costs. The mathematics have fundamentally changed. When Paul Volcker raised rates above 15%, he had the political and economic room to do so because the debt burden was manageable. The government wasn't borrowing trillions annually just to fund existing obligations. In 2026, we live in a different financial architecture entirely. Global debt, both sovereign and private, has reached levels unprecedented in peacetime history. Central banks have spent the last 15 years suppressing interest rates and expanding balance sheets, creating dependencies throughout the financial system. Entire markets, from real estate to equities to corporate bonds, are built on the assumption of relatively low borrowing costs. Raising rates substantially to combat inflation now would trigger cascading defaults across multiple sectors simultaneously. This is the trap. Inflation erodes currency value. Raising rates to fight inflation threatens systemic stability. Keeping rates low allows inflation to persist or accelerate. There is no clean exit. And this is where silver enters the equation, not as speculation, but as a response to systemic pressure. Silver occupies a unique position in the economic landscape, and understanding this duality is essential. On one hand, silver is an industrial metal. It's used extensively in solar panels, electronics, electric vehicles, medical applications, and countless manufacturing processes. Industrial demand has been growing steadily, driven by technological advancement and the global energy transition. On the other hand, silver has served as monetary metal for thousands of years. Throughout most of human history, silver was money. It was minted into coins, used in trade, and held as savings. Even after currencies moved away from precious metal backing, silver retained this monetary character in the minds of investors during times of currency stress. This dual nature creates interesting dynamics. During economic expansions, industrial demand drives pricing. During monetary uncertainty, investment demand takes over. When both occur simultaneously, you get significant imbalances between supply and demand. We are currently experiencing exactly that convergence. Industrial applications are consuming more silver than ever before. The solar industry alone is projected to use record amounts over the next several years as installations accelerate globally. Electric vehicles contain significantly more silver than traditional combustion engines. 5G infrastructure requires silver. The electrification of everything requires silver. At the same time, investment demand is awakening as people begin questioning the long-term stability of fiat currencies amidst persistent inflation and mounting sovereign debt. Supply, meanwhile, hasn't kept pace. Silver supply comes primarily from two sources: dedicated silver mining, and as a byproduct of mining other metals like copper, lead, and zinc. The challenge is that dedicated silver mining isn't particularly profitable at current price levels when you factor in rising energy costs, regulatory requirements, and the geological reality that easy-to-access deposits have largely been exhausted. New mines take years to develop and require massive capital investment. Byproduct silver supply is tied to demand for the primary metal being mined. If copper demand slows, less silver comes to market as a byproduct, regardless of silver's price. What this means practically is that silver supply is relatively inelastic. It cannot rapidly increase in response to higher prices the way that, say, oil production might eventually respond to higher crude prices. Annual mine production has been essentially flat for years. Some years it increases marginally, other years it declines, but it's not growing substantially. Meanwhile, annual demand has been exceeding annual supply for several consecutive years. The deficit is being filled by above-ground inventories, existing stockpiles held by various entities. Those stockpiles are finite. Exchange-reported inventories have been declining. Visible silver held in vaults and depositories has been drawn down substantially over the past few years. This isn't speculation. This is observable data reported by exchanges and depositories. At some point, declining inventories meet rising demand, and the market has to clear at a different price level. That's not a prediction. That's basic economics. The question isn't whether this dynamic exists. The question is what happens when the tension breaks. Here's where things become more complicated and where comparisons to 1980 become relevant. The silver market, like most commodity markets, operates on two levels: the physical market and the paper market. The physical market involves actual metal changing hands, bars, coins, industrial feedstock, real transactions for real delivery. The paper market involves contracts representing silver, primarily futures, and options traded on exchanges. The vast majority of these contracts are settled in cash, not physical delivery. They're financial instruments used for hedging, speculation, and price discovery. The paper market is exponentially larger than the physical market. At any given time, the notional value of silver derivatives may represent many times the amount of physical silver that could actually be delivered. This isn't inherently problematic. Most commodity markets function this way. Financial markets require liquidity, and derivatives provide that liquidity. The system works as long as most participants don't demand physical delivery simultaneously. But what happens when confidence in paper claims erodes? What happens when industrial users concerned about supply demand physical delivery? What happens when investors, worried about counterparty risk or currency debasement, insist on holding the actual metal? You get what's called a squeeze. A squeeze occurs when the demand for physical delivery exceeds the available physical supply at the current price. Participants holding short positions, meaning they've sold contracts they don't have the metal to deliver, are forced to buy in the open market to cover their obligations. This drives prices higher, which triggers more covering, which drives prices higher still. The feedback loop can be dramatic. In 1980, the Hunt brothers attempted to engineer exactly this scenario by accumulating both physical silver and futures contracts, trying to force shorts to cover at higher prices. Today, the squeeze potential isn't being driven by individual actors trying to manipulate the market. It's being driven by fundamental imbalances between the physical supply available for delivery and the volume of paper claims against that supply. That makes it more dangerous, not less. Let's return to the core thesis. Why is this potentially worse than 1980? The answer lies in the response available to authorities. In 1980, when silver spiked, the Federal Reserve could raise interest rates dramatically. Exchanges could change margin requirements. Regulators could impose position limits. The government could even lean on participants directly, as happened with the Hunt brothers. Those tools still exist today, but they operate in a different context. Raising interest rates substantially in 2026 would threaten the solvency of governments, corporations, and financial institutions with unprecedented debt burdens. The Federal Reserve has already demonstrated reluctance to maintain even moderately restrictive rates when market stress appears. Changing exchange rules might slow speculative activity, but it doesn't address the underlying physical deficit. You can't regulate metal into existence. Moreover, if the driver of silver's move is genuine investment demand responding to currency concerns, regulatory intervention might actually accelerate the move by confirming to investors that authorities are uncomfortable with price discovery in monetary metals. Now, this is the key difference. In 1980, the primary driver was speculative excess that could be broken through monetary tightening and regulatory action. In 2026, the primary drivers are structural deficits and monetary system stress that cannot be easily resolved through traditional policy tools. When investors lose confidence in paper currencies, they seek tangible alternatives. Gold and silver have been those alternatives for millennia. No amount of regulation changes that historical pattern. And here's the critical point. Central banks know this. They understand monetary history. They understand the role precious metals play during currency crises. This is precisely why central banks themselves have been accumulating gold in recent years at the fastest pace in decades. If the institutions responsible for maintaining currency stability are hedging with monetary metals, what signal does that send to thoughtful investors? Let's separate investment demand from industrial demand for a moment, because the industrial story alone is significant. The global economy is in the middle of a massive electrification trend. Solar installations are accelerating worldwide as countries pursue energy independence and climate goals. Electric vehicle adoption is growing despite various headwinds. The build-out of electrical infrastructure to support this transition requires enormous amounts of conductive metals, particularly copper and silver. Silver is the most conductive metal that exists. For certain applications, particularly in photovoltaics and high-efficiency electronics, there is no adequate substitute at scale. The solar industry is particularly important here. Each solar panel contains silver. The higher the efficiency, the more silver required. As panel efficiency increases and installations multiply, silver consumption from this sector alone continues reaching new records. This demand is relatively price inelastic. A solar developer isn't going to cancel a billion-dollar project because the silver component cost increased 20%. The silver might represent a small fraction of total project costs, but the panels don't work without it. Electric vehicles present a similar dynamic. The silver content in EVs versus traditional vehicles has increased substantially due to the electrical components, battery systems, and charging infrastructure. As EV penetration grows globally, silver consumption from this sector rises accordingly. Medical applications, water purification, specialized manufacturing, all of these contribute to industrial demand that isn't discretionary. It's demand based on silver's unique physical properties. Now layer investment demand onto already tight industrial fundamentals. If industrial demand alone is consuming most of annual supply and investment demand increases even modestly, where does the additional metal come from? Existing stockpiles can buffer these imbalances temporarily, but stockpiles drawn down over several consecutive years eventually reach levels where market participants become concerned about availability. When that concern translates into hoarding behavior, particularly among industrial users worried about future supply, the dynamics accelerate. This is how physical shortages develop even when the official price hasn't yet reflected that shortage. If you already own physical silver, whether in coins, bars, or other forms, you're holding an asset entering a period of unusual fundamental strength. That doesn't mean the price can only go up. Markets don't move in straight lines. Volatility will likely increase, not decrease. There will be sharp moves in both directions as various participants react to changing conditions. What it does mean is that the underlying case for holding the asset has strengthened considerably. Your position is aligned with several powerful trends: currency debasement concerns, industrial supply deficits, declining inventories, and the historical pattern of precious metals outperforming during periods of monetary stress. The intelligent approach is patience combined with conviction. Patience because these macro trends unfold over months and years, not days and weeks. Markets can remain irrational or suppressed longer than seems reasonable. Prices can fluctuate wildly on relatively minor news. Short-term volatility is noise. The signal is the underlying fundamental shift. Conviction. Because when you understand why you hold an asset, temporary price movements become less emotionally disturbing. If you bought silver as insurance against currency instability and that instability is intensifying, short-term price dips are buying opportunities, not reasons to panic. Here's what you should not do. Don't become overconfident. Don't assume this is guaranteed. Don't leverage your position thinking you can amplify gains. Don't start treating your holdings as trading vehicles, buying and selling based on short-term price action. Physical silver is a long-term strategic holding, not a trading sardine. You hold it because of what it represents: tangible value, industrial utility, monetary history, and independence from the financial system's promises. If the scenario we're discussing unfolds, your holdings will likely increase substantially in purchasing power. But even if the timeline extends longer than expected, you still hold real assets with inherent value and utility. That's the mentality. Prepared, patient, and grounded in fundamental understanding rather than price obsession. If you're watching these developments but don't yet hold silver, the question becomes, what's the appropriate response? First, recognize that getting positioned is not the same as speculating. Strategic accumulation based on fundamental analysis is different from chasing up price momentum or gambling on short-term moves. The case for holding some silver as part of a diversified portfolio has rarely been stronger from a fundamental perspective. Supply deficits, monetary concerns, industrial demand growth, these are compelling reasons, regardless of timing. But timing still matters from a risk management standpoint. The prudent approach is gradual accumulation rather than attempting to perfectly time an entry point. Markets can remain irrational. Prices can be suppressed through paper market activity. Even as physical fundamentals tighten, trying to wait for the perfect moment often means missing the opportunity entirely. Consider building a position over time, perhaps through regular purchases regardless of price, a strategy called dollar cost averaging. This removes the emotional pressure of trying to catch bottoms and ensures you're participating in the trend if it develops as fundamental analysis suggests. Physical ownership is preferable to paper claims for the reasons we discussed earlier. Coins and bars held directly or in allocated storage represent actual ownership. ETFs and unallocated accounts represent promises that may become problematic if physical delivery becomes stressed. This isn't paranoia, it's understanding counterparty risk. During the very scenarios that make silver attractive, namely financial system stress, paper claims become most vulnerable. How much should you allocate? That depends entirely on your individual circumstances, risk tolerance, and existing portfolio. Precious metals are typically considered portfolio insurance, not speculation. Historical recommendations from various strategists range from 5 to 20% of investable assets, adjusted for individual circumstances. What matters more than the specific percentage is the thinking behind it. You're positioning for scenarios the broader market may not be pricing in: persistent inflation, currency instability, supply shortages, or systemic financial stress. These are low probability, high impact scenarios. You don't position everything for them, but you don't ignore them either. We need to address something that confuses many observers. How can fundamentals be this strong while prices remain relatively modest? The answer involves understanding how price discovery works in modern commodity markets. Price discovery happens primarily through futures markets, not physical markets. The price you see quoted for silver is determined by trading activity on exchanges where most contracts are settled in cash, not delivery of metal. Large financial institutions trade enormous volumes in these markets, often for purposes that have nothing to do with actual supply and demand for physical metal. They might be hedging other positions, implementing algorithmic strategies, or engaging in short-term speculation. Because the paper market is so much larger than the physical market, price can be influenced by trading activity that doesn't reflect physical fundamentals. This isn't conspiracy theory. This is observable market structure. When someone sells 10,000 silver contracts in a few minutes, that's not someone selling physical metal. That's someone impacting price through financial market activity. Can this continue indefinitely? No. Eventually, physical fundamentals assert themselves. When industrial users or investors demand physical delivery in sufficient size, the paper market either delivers metal or breaks down. What we're likely watching is the late stage of a period where paper market pricing has diverged from physical market reality. These divergences can persist surprisingly long, but they don't persist forever. The wider the gap between paper price and physical scarcity becomes, the more opportunities are created for those who understand the difference. This is why accumulating physical metal at prices that don't yet reflect supply stress is potentially advantageous. You're buying before the revaluation that occurs when price discovery shifts from paper to physical. But again, timing is uncertain. The divergence could persist longer. Price suppression through paper market activity could continue. What matters is positioning ahead of the resolution, not predicting exactly when resolution occurs. Markets remain irrational longer than most investors remain patient. Your advantage is understanding the fundamental case well enough to maintain conviction during irrationality. Let's examine historical patterns, not to predict the future, but to understand how markets typically behave during similar conditions. Precious metals have gone through multiple cycles of accumulation, breakthrough, and exhaustion. The 1970s cycle culminated in 1980. Another cycle developed in the 2000s, peaking in 2011 when silver briefly touched nearly $50 again. Each cycle had similar characteristics: extended periods of accumulation where prices moved modestly, frustrating holders, then inflection points where fundamental or monetary conditions shifted, then acceleration as broader markets recognized the shift, then eventual exhaustion as sentiment reached extremes. The accumulation phases often last years. They're characterized by improving fundamentals that aren't yet reflected in price. Supply deficits develop, inventories decline, industrial demand grows, but price remains range-bound because investment demand hasn't awakened. The inflection happens when something changes psychologically. Sometimes it's a specific event, like a currency crisis or supply shock. Sometimes it's simply the cumulative weight of fundamentals reaching a point where markets can no longer ignore them. The acceleration phase can be dramatic. Once investment demand engages, particularly from institutional capital or broad retail participation, prices can move faster than seems rational. This is when media attention increases, when everyone suddenly wants to talk about silver, when new investors rush in. The exhaustion phase eventually arrives when sentiment reaches extremes, when everyone who wanted to buy has bought, when prices disconnect entirely from fundamentals in the opposite direction from before. Understanding this cycle is important for managing expectations and emotions. If we're currently in the late accumulation phase, as fundamentals suggest, then patience is required. The inflection could be tomorrow or months from now. Markets don't send invitations. When acceleration begins, resist the temptation to become euphoric. That's when discipline matters most. When everyone around you is celebrating, that's when you remember that cycles eventually exhaust. The investors who benefit most from these cycles are those who position during accumulation, maintain conviction during the inevitable frustrations, and manage emotions during acceleration by remembering that nothing goes up forever. Those who benefit least are those who ignore accumulation, chase during acceleration, and hold through exhaustion, waiting for new highs that may not come for years. Where are we now? The supply data, inventory trends, industrial demand growth, monetary conditions, and institutional positioning all suggest late-stage accumulation. But markets can remain in accumulation longer than seems reasonable. What matters is positioning appropriately for the cycle you believe is developing while accepting you can't control timing. Let's discuss the phrase in our title, bankrupt the system. That requires explanation because it's dramatic language for a serious concept. Modern financial markets are interconnected in complex ways. Derivatives link various asset classes. Institutions hold positions across multiple markets simultaneously. Leverage amplifies both gains and losses. Counterparty relationships create webs of obligation. When one market experiences severe stress, that stress propagates through connections to other markets. This is called contagion. Silver is embedded in this system through derivatives, markets, ETFs, mining company financing, industrial supply chains, and bank positions. It's a relatively small market in terms of total value compared to equities or bonds, but it touches many parts of the financial ecosystem. If silver's price were to move dramatically higher, particularly if driven by physical shortages forcing delivery failures, the impacts would cascade. Mining companies would experience windfall profits, while industrial users faced input cost shocks. Derivatives positions would generate enormous winners and losers. Banks and institutions with short exposure would face margin calls and potential losses. ETFs claiming physical backing would be tested on whether they actually hold the metal they claim. In a scenario where numerous entities have sold more claims against silver than they can physically deliver, and delivery is demanded simultaneously, you get a systemic event. This isn't predicting it will happen. It's explaining why the phrase bankrupt the system isn't hyperbole if certain stress scenarios unfold. The system is designed around the assumption that physical delivery is rarely demanded. It functions on fractional reserves in the commodity space, just as banking functions on fractional reserves in the monetary space. This works fine until confidence breaks and everyone wants the physical asset simultaneously. Could regulators intervene to prevent this? Possibly. They could change rules, halt trading, impose settlement restrictions. But each intervention comes with costs. If authorities step in to protect short sellers or prevent price discovery, they confirm to the market that paper claims aren't reliable. This potentially accelerates demand for physical metal, making the underlying problem worse. If they allow the market to clear naturally, some entities may fail, creating financial instability. There's no clean solution once you reach that point. The time to prevent systemic risk is before it develops, not after. This is why monitoring how the situation develops matters. We're not rooting for system failure. We're recognizing that systems under stress behave unpredictably, and positioning accordingly makes sense. Let's be explicit about behaviors to avoid, because markets bring out emotional and irrational behavior, especially during periods of excitement or fear. First, do not overleverage. Using margin or debt to amplify your position in silver might seem attractive if you're convinced prices are going higher, but leverage destroys otherwise intelligent investors when timing proves imperfect. Markets can move against you long before fundamentals are proven right. Second, do not follow online hype uncritically. Social media and forums are filled with people sharing opinions about silver, some informed, many not. Confirmation bias is powerful. When you hold an asset, you naturally gravitate toward people telling you you're right. This creates echo chambers where unrealistic expectations develop. Seek out serious analysis from multiple perspectives. Read the bear case as well as the bull case. Understand where you might be wrong. This keeps your thinking grounded. Third, do not react emotionally to short-term price movements. If you've positioned based on long-term fundamental analysis, daily or weekly price changes are noise. Getting excited by rallies or depressed by declines is exhausting and counterproductive. Fourth, do not neglect other aspects of financial preparedness. Silver or precious metals generally should be part of a broader strategy that includes emergency savings, manageable debt levels, income stability, and diversification. No single asset class is sufficient preparation for all scenarios. Fifth, do not confuse conviction with certainty. You can have high confidence in your analysis while accepting you might be wrong, or that timing might be far different than expected. Humility prevents catastrophic mistakes. Sixth, do not ignore tax implications. Depending on your jurisdiction, precious metals may be taxed as collectibles or in other ways that differ from standard investment treatment. Understand the rules in your location. Seventh, do not neglect security. Physical metal needs to be stored safely, whether at home or in a secure facility. Insurance, proper storage methods, and discretion about what you own all matter. Finally, do not assume you need to trade this. The temptation when prices start moving is to try to trade in and out, capturing gains and avoiding dips. Most people who attempt this end up with worse results than simply holding. Trading incurs transaction costs, creates tax events, and requires timing the market repeatedly. The odds are against you. The most successful commodity investors historically have been those who understood the fundamental case, positioned appropriately, and held through volatility. They made money despite being wrong about timing repeatedly. Your goal should be positioning for the scenario you believe is developing, not perfect execution of trades. Let's synthesize what we've covered into a coherent picture of the current moment. We have industrial demand for silver at or near record levels, driven by electrification trends that are likely to continue regardless of economic conditions. We have supply that hasn't meaningfully increased in years and is constrained by geological and economic realities. We have inventories that have been drawn down substantially and continue declining. That's the physical side. On the monetary side, we have unprecedented global debt, central banks trapped between inflation and growth concerns, currencies under stress, and institutional investors beginning to question the sustainability of current policies. We have central banks themselves accumulating gold while governments struggle with fiscal sustainability. That's the macroeconomic backdrop. In the silver market specifically, we have a paper market many times larger than the physical market, with derivatives, positions that assume physical delivery will remain rare. We have price discovery happening primarily through this paper market, creating potential divergence from physical fundamentals. That's the market structure. The question isn't whether these conditions exist. They're observable and documented. The question is what happens as they develop further. If industrial demand continues growing while supply remains constrained, deficits widen. If investment demand awakens as monetary concerns intensify, deficits widen further. If inventories reach levels where market participants become genuinely concerned about availability, behavior changes, these are sequential probabilities, not certainties. Each step makes the next more likely. We appear to be several steps into this sequence. The comparison to 1980 is relevant not because we'll see an identical outcome, but because we're facing similar monetary stress with fewer policy tools available to address it. The pressure builds in similar ways, but the release mechanisms are different. In 1980, authorities could and did break the cycle through aggressive action. In 2026, aggressive action carries risks that may be deemed unacceptable, given debt levels and financial system fragility. This is what makes the current situation potentially more serious, not because silver specifically matters to the system, but because what drives silver's fundamentals, monetary instability, and resource scarcity, are problems without easy solutions. So what should a thoughtful investor actually do with this information? First, educate yourself further. This presentation is an overview, not a comprehensive analysis. Read about monetary history, study previous precious metal cycles, understand how commodity markets function, learn about the specific industrial applications driving silver demand. The more you understand, the better your decisions will be. Second, assess your personal situation honestly. What are your financial goals? What's your risk tolerance? What's your time horizon? How does silver or precious metals generally fit into your overall strategy? These answers are individual. What makes sense for someone in their 30s building wealth differs from someone in their 60s protecting wealth. Third, make deliberate decisions rather than emotional reactions. If you decide to position in silver, do so based on analysis, not fear or greed. If you decide it's not appropriate for you, that's equally valid. What matters is that your decisions are informed and intentional. Fourth, maintain perspective. Markets are cyclical. Trends develop and exhaust. Nothing goes up forever. Even if everything discussed here unfolds as fundamental analysis suggests, there will be volatility, setbacks, and periods of doubt along the way. Fifth, stay informed but not obsessed. Follow developments in commodity markets, monetary policy, and industrial trends at a level that keeps you informed without consuming excessive time or mental energy. Checking prices hourly or daily is counterproductive if your thesis is based on multi-year trends. Sixth, Build and maintain conviction through understanding, not through echo chambers or confirmation bias. Regularly challenge your assumptions. Seek out intelligent arguments against your position. This keeps your thinking sharp and honest. Finally, remember that the goal is protecting and growing purchasing power over time, not getting rich quickly. Approaches based on patience, discipline, and fundamental understanding tend to succeed. Approaches based on timing, speculation, and emotion tend to fail. The investors who will benefit most from the current environment are those who understand what's happening, position appropriately for their circumstances, and maintain discipline through whatever volatility emerges. We've covered substantial ground in this discussion, examining supply fundamentals, monetary conditions, market structure, historical patterns, and practical implications. The core message is simple. Silver is entering a period of unusual fundamental strength driven by factors that are observable and understandable. Supply constraints, growing industrial demand, declining inventories, and monetary system stress are creating conditions that historically have led to significant price adjustments. This doesn't mean prices can only go up or that timing is predictable. It means the asymmetry between downside risk and upside potential appears favorable for those positioned in the asset. For those who already hold silver, the appropriate response is patience and conviction. The case you made when you acquired the asset has strengthened. Stay focused on fundamentals rather than price noise. Remember why you hold what you hold. For those considering whether to position in silver, the appropriate response is education followed by deliberate action. Understand the case thoroughly. Assess how it fits your circumstances. Then make informed decisions and stick with them through inevitable volatility. For everyone, the appropriate response is maintaining perspective. No single asset is a complete solution. No analysis is perfect. Markets are humbling and uncertainty is permanent. What matters is thinking clearly, acting deliberately, and maintaining discipline. We're watching a significant shift develop in commodity markets and the broader monetary system. These shifts create both opportunities and risks. How you navigate them depends on understanding, preparation, and emotional control. The phrase, "bankrupt the system" in our title isn't meant to be sensational. It's meant to capture the seriousness of the stresses building in financial markets when paper claims potentially exceed physical reality and when monetary authorities have limited tools to address the underlying imbalances. Whether this leads to systemic disruption or gets managed through some combination of policy intervention and market adjustment remains to be seen. What's clear is that the conditions exist for significant volatility and potential repricing of assets that have been undervalued relative to their fundamentals. Your responsibility is to understand these conditions, assess how they impact your circumstances, and position accordingly, not with fear, not with greed, but with clear thinking and measured action. The investors who succeed in environments like this are those who do their homework, make informed decisions, and stick with their convictions through the noise and volatility that inevitably follows. Markets reward patience and punish impulsiveness. They reward understanding and punish ignorance. They reward discipline and punish emotion. As we move through 2026 and beyond, these timeless principles matter more than ever. Stay informed, stay disciplined, stay focused on what you can control, which is your own understanding and actions, not market timing or price movements. Thank you for your attention to this important topic. The financial landscape is shifting. Those who understand these shifts and prepare thoughtfully will navigate whatever comes with greater confidence and success than those who react emotionally or ignore the signals entirely. The opportunity is there. The risks are real. How you respond is up to you.